What is going on, everyone? I get asked all the time by traders, how should they invest their money? Young guys at SMB, young guys over Twitter. So today I'm going to address that question and discuss all the money management mistakes I've seen so many young traders make. Last week I was traveling with young stud trader Jack Kellogg, and he was picking my brain on this topic as well. And so that was kind of like the final straw where I'm like, okay, clearly there's demand for this. It's a really important topic, and this is something I've kind of learned the lessons the hard way. So hopefully I can provide a lot of value helping all you out, like I hopefully helped Jack. So having spent over a decade at a prop firm, I've seen hundreds and hundreds of traders make the same mistakes again and again and again. So I'm going to share with you all the dumb things I've seen, as well as how I handle my business, and just like a lot of the best practices involved. But before we dive into that, first the disclaimers. This isn't financial advice. I'm not a wealth advisor or anything like that. I'm just a trader that's seen a lot of dumb mistakes by smart traders, dumb traders, and everyone in between. It happens again and again and again. So every single trading class, I give the young traders the same advice, but some stuff you really need to learn on your own. I had to learn the hard way. I'm sure you will as well. So once you've watched the video, ignored the advice, lost money, underperformed the market, learned the hard way, come back and let's try again. And like, I think this is so common because traders think their trading acumen makes them stock market geniuses. And I would actually bet there's a correlation where the better the trader you are, the more overconfident you become because you think you're so good at trading, but it's just not the same as investment or building up a nest egg. And I think in aggregate, those traders probably tend to underperform the markets more in their own personal accounts. And I think I've seen this over just such a large data set by now, but like, you need to realize trading and investing are totally different. You've built up a skill set in one area, does not apply to money management. It is very, very different. That means your yellow option plays are probably stupid, your hot stock picks are probably stupid, crazy crypto coin, whatever is probably stupid. Anything hot, cool, and hyped is probably not going to be a good idea. And I know we like to think we're different. We like to think, oh, we're special, we can beat the market. Everyone always thinks that. Until the market then proves them otherwise in the long run, and the damage is already done. And one thing that I need you all to realize is this is so important for traders, because traders have very, very short careers, right? Unlike most careers where you might be on a 40, 50-year path of accelerating and increasing earnings power, we're much more like the earnings curve of an athlete. This is a very hard job. We peak early, we peak hard, and then we don't last forever. There is no guarantee you will get another epic market. There's no guarantee you'll have edge 3 years, 5, or 10 years from now. We work really, really hard for the money we earn. You cannot afford to blow up chunks of your nest egg. If you're 10 years into your trading career, 15 years into your trading career, what are the odds you get another 15 or want to do another 15? You need to side with prudence and conservatism in your nest egg, given the risky nature of our jobs. So like, with that said, here are some of the biggest lessons I tell young traders. So the #1 rule for a beginning trader is, if you're developing, the #1 investment you can ever do is investing in yourself and your trading. This might be mentorship, proper sleep, health, getting good reliable computers and software, outsourcing some of the distractions like laundry or cleaning your apartment. Especially early on, when small amounts of money won't be material to your long-term trajectory, whether you make it in trading or just have a career somewhere else, it's better to invest in your career than put 50 bucks into the S&P 500. It's just not going to make a difference. Then a very similar corollary to that, any investment you do that starts to take up your time, your focus, or stresses you out or distracts you from focusing on your trading is going to be a bad investment. At work, all the time, this would be my biggest pet peeve. We would make rules that new traders aren't allowed to trade their personal account because it would just distract them from focusing on what I was teaching them. And they would still end up breaking that rule just to like gamble with like 100 bucks doing something really, really dumb. So if you're starting out and you don't have much capital, trust me, focus on yourself and your trading, worry about the nest egg stuff later. So now let's assume you've had some level of success. You've built up some level of a nest egg, and you got to start to really make some decisions. The first thing I think for a lot of young guys is like, this needs to be said, you don't ever want to give a friend a loan, ever. Like, if you're gonna lend your friend money, just do it as a gift, and if they pay it back, that's icing on the cake. You need to mentally accept that like things can get really weird when doing stuff with friends, right? Like, Don't invest in your friend's business. If you want to support him, just give a small amount as a gift. Don't fall for your friend's new crypto coin either. Like as a very safe rule, you want to stay as far away as possible from commingling your money with your friendships. Even the best of friendships and the best of people can become total pricks when money and greed become involved. Like, I can't stress this enough. Like, you want to think really, really long and really, really hard about getting financially involved with your friends. If you're going to do so, always get everything in lawyer-approved writing. Then the other thing I would really urge you to ask is that investment opportunity worth more to you than your friendship? If not, think really, really hard about doing it. I know you might be optimistic and you think, oh, this is my best friend. What could ever go wrong? This stuff goes wrong. I've seen it time and time again. Do not commingle your money investments with your friends. Gifts if you're going to do anything. Very big picture, I think investing performance also comes down to realizing two things. Like, regardless of how you personally choose to allocate based on your risk tolerance, your goals, whatever, the two repeated things that are always smart is you generally want to minimize fees. You generally always want to minimize taxes. So many people think they're going to beat the market. They forget about the 40% plus short-term capital gains. They forget about the 20% plus long-term capital gains. They forget about the management fees, the margin fees. Overall, all that stuff just tears you up. I've seen so many people come to me with investments. Then once they factor in the fees, the taxes, the capital gains, it does not outperform the market, let alone for all the other stress and headache you got to deal with. So based on that, really every single thing I do is to allow myself to compound over the very long term without paying capital gains or taxes and minimizing those fees. So I tend to have a time horizon of infinity essentially, right? I've got some buckets and cash on hand if I need it, but really I'm trying to invest philanthropically for the future. And really I want to compound just so that I can make the biggest impact. So like as part of that, like when you first start out, the number one thing you want to do is probably speak to a trusted financial advisor or estate planner, especially about a will, disability insurance, and life insurance. It's like I was talking to Jack about this. For him, this was a no-brainer where like, I know we think we're young and invincible. I've seen some crazy things happen to very healthy, smart, prudent people. A will is a no-brainer at a certain point. Disability insurance, if you're starting to really make some money trading, it is a no-brainer, right? I knew that if I, God forbid, got injured or for whatever reason couldn't work in the capacity that I was trading, my alternative income, getting a different job or not working, would have been a fraction of that. So very early on, I invested in some very high-end disability insurance. God forbid something went wrong. I did not want to change my quality of life. Some of that stuff really tends to be a no-brainer. Once you really start to reach the big leagues, you want to start thinking about trusts. That's generally for the multi-million area, but trusts can also allow you to kind of compound in a much more tax-advantaged manner. God forbid you eventually die or pass it on to someone else. Very, very essential. And they're kind of just like the low-hanging fruit where it's a lot of unforced errors. God forbid you pass away or you end up incapacitated or you can't trade. It's just not really what you want to end up dealing with. The other really great advice I think is always a safe, simple heuristic, which is follow what Buffett teaches. He really talks about investing for the long run. He really believes for most people the best thing you can do is index funds, low-fee index funds. I tend to agree with a lot of that. Like the market will be very, very volatile and crazy, but overall will go higher over time, and especially with cap gains and stuff, that tends to be the best way to capture it. And really stay away from some of that hedge fund crap. I've been able to get access to that stuff and I really dug into it, and like the fees tend to just be egregious, and this stuff, some of it outperforms, some of it doesn't. Like I'm really not so big of a fan of that space. There are some exceptions that I'll discuss later where some people do have structural advantages. But overall, you need to be very, very cautious of some of that stuff. Some of the biggest promises and the biggest hype does not tend to continue. Another good rule, invest more when people are panicking. The deeper we pull back, the more I want to be investing. The higher we go, the less so. In 2022, I actually wasn't even putting money in the market anymore. I was just kind of hoarding because things kind of seemed pretty crazy. So I do try a little bit to play the sentiment pendulum, where when things get super, super euphoric, I want to invest less or not at all. Then when things all of a sudden pull back, that's kind of when I want to be adding. keep in mind you can always systematically just dollar cost average and take all the questions out of the game. I've seen so many traders think stocks are expensive, then they miss out on 10 years of returns by being underinvested. So if you're gonna waste mental effort trying to time the market, or if you're gonna miss out on the market, like, you really need to think about that long-term time horizon. 50, 60, 70 years, the market will be higher. So just put your money in, close your eyes, go back to rule number one, focus on trading. Again, like, never ever distract yourself with some of this stuff. Another big thing is be careful of high fee advisors. Be careful of getting pressured into investing with people. You want to reduce the fees the most you can. There are situations where advisors make sense. If you're someone that gets stressed or distracted by these decisions, if you're someone that makes dumb decisions on your own, and you're the type of person that will panic in a market pullback rather than doing the opposite and adding more, sometimes an advisor can be the best money ever spent. It's almost worth it alone just to be able to simply close your eyes and let someone else take care of it. For all my investment advisor accounts, I don't even log into them. I trust these guys. I close my eyes. I know it's there if I need it. Out of sight, out of mind, I can focus on doing what I want to do in the world. So the other big thing, the older and wealthier you get, the more and more you want to move into safe buckets. You only need to get rich once, especially in trading. You do not want to rebuild your wealth after taking a huge hit to your nest egg. Part of the risks I've taken in my personal account or in my trading were largely enabled by the fact that I had built up those safe buckets, so I knew I'd never end up losing a lifestyle or quality of life that I wasn't willing to risk. It is so important to have those safe buckets. By safe buckets, that might be cash, that might be treasuries, that might be CDs, that might be stable real estate, a lot of different ways to be safe with that stuff. Similarly, based on being safe and prudent, always be cautious with debt and leverage. There is nothing wrong with the mortgage that you can handle, but always side with conservatism. I have mortgages, I've had many before in the past, I have all sorts of different loans, but these are all at low interest rates. They're all stuff that's cash flowing, or it's stuff, you know, that where it just made sense. We have risky jobs, right? Life is risky and certain. You only want to layer so many different levels of risk, and you really want to minimize it in some of those safe buckets. So really be smart with leverage and with debt. Another thing to keep in mind, there's no right allocation or perfect advice. It all comes down to what's right for you and your needs and preferences and your situation. A really great book on this is Morgan Housel's Psychology of Money. This details how these are very personal decisions where what might seem rational in theory, or irrational to not follow is totally wrong when it comes to your own personal situation. So if theory says, oh, you should be invested in equities, but you're the type of person that's going to stress over them or hit out if the market pukes, that's not right for you. So only invest in a way that allows you to sleep at night. Always assume that investments can and will go 2 times or 3 times further than you'd normally imagine. I have seen so much crazy stuff in just the last, I don't know, 12, 13 years of Wall Street. Like, there will always be more things, and you need to ask yourself, can you stomach it? And like, when you're actually, it's like the old boxing saying, you know, everyone has a plan until you get hit in the face. Like, thinking, oh, I can stomach some huge drawdown. I had a lot of friends pile into crypto at 50, 60, 70,000. It sounds like, oh, I'm willing to risk this money. Yeah, not so when Bitcoin's at 20,000 and all of a sudden, like, you know, your wife or your partner is like, what the F did you just do to our nest egg? Becomes way harder in reality. Another interesting thing is I know some huge traders that take on a huge amount of risk, but then they're nest egg scaredy cats. That doesn't mean they're wrong. That doesn't mean they're dumb. They're doing what's right for them. The other thing is, like, feel free to break these rules. Oftentimes it'll work out fine, and that's kind of the issue, because you'll think the rules don't apply to you, then bam, all of a sudden it goes wrong, you get hit in the face, and you're like, oh my God, I'm never doing that again. I only learned these the hard way. You're gonna make mistakes. I'm gonna make more mistakes, I'm sure. As they say, you F around, then you get found out. So now I'm gonna dive into what I actually do, just to make it specific to me. So basics, I always try to have expenses, like 6 months of expenses in cash. This is kind of like a just old school rule of thumb that's always held true for a lot of people. I don't go overboard with the cash stuff though. Too many people, I think, tend to get ravaged by inflation and not realize it, especially now with where rates are. You might as well just be in a preferred deposit account or treasuries or whatever, just so you're kind of trying to keep up with inflation. Then otherwise, I try to be fully invested for the very, very long run. Again, time horizon is essentially my death. I don't see myself going to college again. I currently don't have any kids or anything. So for now, I can just kind of maintain the course of like the biggest thing I want to do is accumulate for the future beyond like nonprofit needs and my daily expenses. If I did have any debt at stupid interest rates, like after like tax adjusting for interest payments, if it's even close to market returns, I'd rather take the bird in the hand and pay off the debt. But that's just kind of me. For the most part, I really just largely passively invest in index funds. One of the best things Lee Mashler, the owner of Trillium, does for the traders is each year he gets some of the top Vanguard guys to give a seminar to us on the benefits of passive investing, and I think it's so smart that he does that because it really helps a lot of traders that will otherwise run astray. I used to have a Vanguard account, but this was an area where a financial advisor actually made sense for me because due to my tax bracket and the charitable giving, there's tax harvesting index funds that add alpha for my specific situation. So I use a trusted Merrill Lynch advisor that I'm friends with. He's able to get me super cheap access to these funds. So when I factor in his fees, I actually end up ahead because the money he saves me on these tax harvesting funds actually ends up being more. The other thing that an advisor can do like Merrill Lynch is if I want to invest in an ETF, say like the S&P 500, if I buy the underlying stocks at large enough values, simply paying commissions and avoiding the annual fees that an ETF has is actually more cost affordable, but that's only at kind of large dollar amounts. Another thing I try to do is diversify, of course. I like owning real cash flowing assets I can really understand and be confident in their returns, like underappreciated local real estate markets. The one downside of some of this stuff is it creates potential management headaches, right? Like if you're gonna go out and buy an apartment, who's gonna manage it? Who's gonna deal with the headaches? Will that distract you? Will you wanna put up with the accounting headaches and this and that? So you wanna be very, very intentional with the decisions you make. But at certain returns and confidence levels, I do think it's worth diversifying away from equities and everything else. But another huge rule of mine is I want to minimize as many decisions as possible. I don't want to waste my time on investment decisions. I want to have my game plan, I want to follow it and not spend any more time. It might not be perfectly optimal, but it's optimal enough. My advisors know I'm never selling. I'm sophisticated, I'm not going to panic on the down moves, I'm going to want to buy more. They know I don't want unnecessary capital gains. They know not to shill me some of the high fee bullshit. They know that I'm really trying to just minimize stress and decision making while letting it compound for the long run. We're all on the same team, we've all got the same vision. So now, because I am human, and I think the reality is everyone's going to listen to this and kind of steer astray, I'm going to share with you kind of where I don't follow my rules. And in fact, even a chunk of my personal account success came from boating oil futures in like 2020. And it's like that definitely wasn't in the playbook, but even then I was smart enough to at least build a structure of rules for why I was doing and how I would do it, and had my guardrails with the safe buckets that I could fall back on. And I still sometimes do this. So to give you an example of like some of the safeguards I'll use or like the systems I'll set up, as of now, like 2023, I'm invested in two funds. One is Quick Capital. They do small and medium-sized business lending loans. This is kind of a couple of my like close friends started this. I believe in my friends. I believe in their edge in this market. I believe in their intelligence, their ethics, and everything else. Another fund is this guy, Cale Smith in the Florida Keys, Island Murata Investment Management. Why did I invest with him? It was kind of like the same deal where like I had been reading his letters over time. I had been reading his work. It was very educational for me. I believed in it. And so like these were both managers that I really wanted to just personally support. Whether they outperformed or not was not that important to me. I had accepted the risk that generally when I break my rules, I get burnt. But it was still important to me just because of the people and the relationship I had with them. So I think that's a huge thing is if you're gonna break the rules, you need to accept that things can go drastically wrong. Things will definitely go wrong. It just always happens way more than you think. The other thing why I did this is I felt that these people had very structural edges in kind of like the markets they were pursuing. And it was also different from my traditional equity exposure. Their fees were way lower than typical hedge funds. Like most hedge funds just absolutely slaughter you where they're just not going to outperform the market. Then you add on the fees and it like the long-term graphs are just disgusting and it's unbelievable that people even give them money. Then as far as like the safeguard, if I do some of this stuff like with these fund managers, it's always an amount that I'm willing to lose and it's not going to meaningfully affect my freedom or my lifestyle. I'm not going to lose sleep over it, never will. So it's really kind of having a reason to do it, having a reason to think why it might perform, accepting if it doesn't, and then having safeguards. So to give you a couple more examples of breaking the rules but doing it intelligently just because we're human, one of my best friends who kind of also learned a lot of these lessons the hard way, he's a huge believer in crypto. He has a blog on it. He loves learning about it. He loves following the market. So he does the passively investing with an advisor, and he still invests in crypto, but it's with the little side account. And he accepts that if this side account goes to zero, so be it. It can still be fine. He gets entertainment and value from it, and that's fine. He's created a safeguard. Another friend of mine loves reading investor letters from especially this one hedge fund. I think it's called Eagle Point Capital is the one he really likes. And like, I'm personally not confident they're gonna outperform. I don't invest with them, but he really enjoys reading about their picks, learning about the thinking, following the market. And I think like if you're gonna do that safely and do it like a small proportion of your overall wealth while having the buckets, like so be it. But the point is just make sure you have guardrails, recognize you're breaking the rules, and just do it very, very prudently. It's just so important. So that overall I think is like the big mistakes I've seen people make, the big advice I give to young traders, as well as kind of what I do. I'd love to learn and hear from you. What are the lessons you learned the hard way? What are your rules or best practices you follow? So let me know in the comments. I appreciate you tuning in. If you enjoyed this video, subscribe to the channel. I've got a lot more good content. I want to share kind of what my week with the controversial Tim Sykes was like. I've got some other ideas I want to share. So I appreciate you all tuning in.